Most people chase returns, but here's the truth: you can't grow wealth by focusing only on profits. You grow it by managing risk and money smartly. Let's break it down. Risk management and money management are essential part of the investment cycle. Risk management is all about identifying what could go wrong: bad news, stock crashes, market panics, and making sure it doesn't wipe out your capital. Money management, on the other hand, is about how you allocate and protect your capital so your investment plans and goals stay on track, no matter what kind of market surprises are thrown at you. Now, let's understand the different methods to manage risk and money. Stop loss, your exit plan to cut losses. Let's say you buy a stock at 100 with a target of 130, but instead some bad corporate news hits and it starts tumbling. Stop loss set at rupees 90 helps you to get out of before things even get more worse. It's not about giving up, it's about cutting the losses short and keeping it minimal through money management and risk management techniques. Taking profit, know when to say thanks. Now imagine rupees 100 stock jumps to 125, approaching a known resistance level. You could hold on hoping for it to go to 150. But what if it reverses? A take profit level helps you to lock in gains, especially when the risk of further upside doesn't justify the downside. Strike rate, winning versus losing trades. So let's say out of 100 trades, only 50 trades are winners. Sounds bad, not necessarily. Reward ratio. Let's simplify it now. You're risking rupees 10 to make rupees 10. The risk reward ratio is 1 is to 1. You're risking rupees 10 to make rupees 20. The risk ratio is 1 is to 2. Now let's combine this with the strike rate. So if your strike rate is 50, but your risk reward ratio is 1 is to 1, you may not make up any money. But if your risk ratio is 1 is to 2, boom, all probability of you really making good money. So the golden formula: higher risk reward ratio, a decent strike rate is equal to better returns. Now let's bring it all together. In our previous videos, we spoke about diversifying across asset classes and sectors to reduce risk. And what if I told you all this is stacked up in our all-rounder? All-rounder is a curated portfolio, uses AI with a multi-asset approach and diversifies investments across asset classes with built-in risk and money management. Here are some words of wisdom. Chasing returns is great, but building wealth, that's about managing risk, protecting your capital, all smartly with the help of AI. So start your smart investment journey with All Rounder. Thanks for watching. See you next time.